We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodjovics. Joining me today is John Williams, founder of shadowstats.com. John, thanks for joining me again today. How are you?
I'm fine, thanks. Thank you so much for having me again.
It's a great pleasure to speak with you, and we're going to go over a lot of things today. But I thought we could kind of start by, for those that don't know, you cover the real inflation statistics, the real GDP statistics, and you have put this data together over many, many years. So maybe we can kind of start by thinking about understanding how the Fed, the Treasury, and even the government can be making the right decisions for the economy or the markets based on data that is misleading them. If they're not getting accurate data, how can they be making the proper decisions about the economy, employment, or even inflation?
Well, they've been the culprits behind the manipulation of the headline statistics. So they have a pretty good sense of where reality is. And I know there are people that are concerned about that. On the other hand, with the public, what the politicians have thought is we'll keep the public happy with good numbers. They'll vote for us. But guess what? That doesn't always happen. Right now, we're seeing headline inflation is coming down. That's the big headline. And this is coming into the election. It's not coming down, at least not fundamentally. The reason that the headline numbers are lower is that the taken action to bring down gasoline prices by releasing gasoline reserves. They bring the gasoline prices down. That brings the CPI down, the consumer price index, and that's what we're seeing with the lower inflation. If you go back to the midterm election, all of a sudden the administration hit the Strategic Petroleum Reserve, which is supposed to protect the United States oil supply in the event of a Mideast war or something, and we end up with another oil embargo. They depleted effectively half the Strategic Petroleum Reserve, which still hasn't been replaced, and brought the gasoline prices down artificially, and that helped bring down the headline inflation going into the midterm election. We're seeing again the same thing happening here, but now they're depleting gasoline reserves. That's not a fundamental improvement in inflation. It's a deterioration of backup and safety to the economy and the well-being of the country. So those numbers can be and in fact at present are being manipulated. If you look at what's really happening, or the headline numbers are economy's booming, the Fed saying, oh, they're huffing and puffing, the economy so strong we have to keep interest rates high to kill the inflation. All sorts of problems in that. First, there is a big inflation problem, but the Fed's not killing it by keeping interest rates high. The Fed wants interest rates high. It's owned by the banking system. The inflation is being driven by the Fed's money supply, which is still off the charts in terms of where it is against where it had been before the pandemic hit. When the pandemic hit back in early 2020, it was in the month of March or April as the pandemic really hit hard. The Federal Reserve just flooded the system with money. They pumped in 30 years worth of monetary stimulus in a couple of months here, and that stimulus is still there. Mm-hmm. So that when you looked at the year-over-year numbers, or looked at, let's say, the level of the liquid money supply, which is what drives the inflation, the currency, the checking accounts, that upfront, the most liquid measure. That's what people go out and spend on products, on food. That's what drives the inflation. They pump 30 years worth of normal stimulus in there, and they've left it there. So that if you looked at the year-over-year change, in that liquid measure at the end of coming into the end of the first year, you're up something like 150% from where you were before. But you go to the next month, all of a sudden you're up 3%. So the Fed says, "Hey, look, we're bringing things under control. It's only up 3% from last year."
Mhm.
But that was against the inflated number. They've never brought down that liquidity, which is a major factor driving the inflation. Another major factor driving the inflation is the government's spending and deficit, just out of control. It's uncontained. No effort to really contain it at this point. And so where the inflation's being contained is in gimmicks with the reporting. And we have seen that before. We saw it again back at the midterm election, and we're seeing it now. And back at the midterm election, and coming into this one, there are problems with gasoline prices being high. Gasoline prices are good. Not saying good from a positive standpoint, but it's a major factor in the consumer inflation. So what happened back in the 2022, the government drained the strategic petroleum reserve, which was set up as a result of the Arab oil embargo, in case we ever had another blow up in the Mideast and we were cut off from oil, we'd have that reserve. Well, they drained 50% of that and put it into circulation to keep the gasoline flowing, but in the process to bring down the gasoline prices before the election, midterm election. Now we're coming into this election, all of a sudden the CPI is coming down. But what's happening here, the Congress did approve. It was not just the administration, but they certainly pushed it. Did approve draining gasoline reserves to keep gasoline prices down. But again, that'll help. That helps a pre-election circumstance, but still leaves you vulnerable in the event of a major conflict in the Middle East, where we end up with another Arab oil embargo or such. There is some risk of that at the moment. Mm-hmm. So the headline numbers at the moment are very political. If you look beyond the gimmicks with the gasoline prices, inflation is a very serious problem. Generally, it's getting worse. And the part of the problems in terms of where it's getting worse against where things are maybe looking not quite as bad is that the government moved to redefine the headline inflation back in 1982. At that point in time, there had been a big surge in the consumer price index. I guess it was 1980, 81. And the way things were set up, Social Security adjustments were made for inflation. But where the inflation was so large, it meant the Social Security adjustment was going to be large, and the Congress didn't have as much money to spend in its deficit spending as it wanted. And at that point in time, they held hearings headed by Newt Gingrich to see what they could do to contain the problem. And what they did was they brought in Catherine Abraham, who was head of the Bureau of Labor Statistics. And I apologize if this is repetitious from what we've discussed before, but it's important understanding what happened here. And she reported it in her memoirs. Gingrich told her, say, hey, if you could find a way of calculating the CPI this way, we might be able to find more money for the Bureau of Labor Statistics. And they did. And I took great offense at that from a number of angles. For the basic concept of Social Security and people who took the Social Security adjustments, this is all part of the deal. It's okay, we'll take the Social Security payments, but they're adjusted for inflation. It really violated the concept by eliminating any realistic inflation measure. And right now, that differential is about 8 percentage points. I mean, I've tracked the way the CPI was,
Mhm.
the changes they've made, and the Bureau of Labor Statistics are very open about what they do. Whenever they make a change, they'll eventually publish a paper on it. Here's the change we made. This is the impact it had. And all I've done is I've just reversed that, because every change over the last 30 years has had the effect of dampening the CPI. None of them increased the CPI, always dampened it. And again, that aggregate change right now is about 8 percentage points. So that, if you're seeing a headline inflation of right now, I think they've got it under just under 2%, just under 3%, and it's 2.9% is just reported. My estimate on that is 10.7%.
And is that year over year change?
That's year over year change.
Okay.
So the average guy who's receiving Social Security adjusted for these numbers is finding it increasingly difficult to make ends meet. But that's the penalty that the American people are paying. The Congress, it helps them balance the budget. They keep their spending in place. Consider that right now you have uncontained federal spending, uncontained deficit growth. Those are factors contributing to the inflation. And we also have the Fed with its having spiked its most fundamental, basic, and liquid money measure by a level that's still something like 125% above where it was before the pandemic. They never brought that in. That's what's driving the inflation. And again, in the reporting of the inflation, they don't. That all the changes made by the government are already wiped out there. That's my dog Molly barking in the background. Usually, when gold prices are going up, she barks. Gold prices should be going up here because of the inflation risk, and I think that's still the best hedge, holding physical gold and silver, but primarily the gold as a store of wealth is the best hedge against the underlying inflation here. That's why gold prices are. What we're seeing with the gold price right now is that it's finally reached the level that my alternate CPI measure has been showing it should be at. It's the gold is your hedge here, physical gold.
Well, I guess that's it. We can wrap up for today then. I mean, there's a lot to go through there, John. And I was thinking we could kind of start by, just thinking about the idea that if, even a simple example, I think, is employers. If they're looking at, 3% year over year inflation versus last year, and it's actually closer to 10, it's no wonder that in the 70s, you could have a one worker household raise a family and be able to make ends meet and have some savings. And yet, when we aren't getting accurate data and wages aren't keeping pace with, if wages are behind 8% per year, then I can completely understand how we've ended up in this place where it's difficult for a two-person household to even make ends meet now.
You've got it in a nutshell. That's it. Mm-hmm. It gives them all sorts of advantages from their standpoint in keeping things under control. But the guy being hurt here is the average American who's living on any kind of a fixed income.
Well, even a non-fixed income, I think you still end up suffering at that point. Yes. But John, we've basically lived in this realm. We're going to put some charts up of this divergence basically in 1980 of where you continue measuring CPI the way that they used to, and then the new CPI measure, or let's say the headline CPI measure, that continues down, and you, as you're saying, there's a divergence of about 8% there right now. How does that end up resolving itself? How does reality end up re-exerting itself, do you think?
Uh, I think it'll be resolved in the political system. Um, the public gets the average guy knows how he's doing, and if he's not doing well, he'll tend to reflect it in when he votes in the elections.
Mhm.
He'll vote his pocketbook. If he's not making ends meet, he'll tend to vote against the incumbent party. And at some point, you're going to have a voter revolution. Um, it'd be, I mean, you want to push that along, it would be a matter really of someone in the political spectrum raising that as an issue and saying, "Hey, look, you're not getting a fair shake here out of the government. Vote me in there, and I'll get it corrected." Nobody's doing that. Um, why? And there are all sorts of political issues and dangers here, and this is something that has been in place now for, again, 30 years.
Mhm.
But it's they certainly need to make an adjustment here to get the average guy back in line. Did I mention consumer sentiment?
No, but we'll move on to that in a little bit if you don't mind. But
Oh, sure.
I want to get your sense for if there's a real difference at this point between either of the parties, whether it's Republican or Democrat, that ends up winning in November. What does the difference end up looking like for the economy and for the markets going forward from that time?
Well, it's you have to consider that both parties have been culpable in this. I mean, this is not just one party or the other. They would have torn each other apart in the system. It was agreed by Congress because Congress wanted this gives Congress more ability to do what it wants with its spending.
Mhm.
It is if someone raised it as an issue and made it an issue before the public and said, "Hey guys, you're not getting a fair shake on inflation. Here's how and why, and elect me. We'll work at that." That would be a very interesting campaign, and I think someone who did that would probably rise very quickly in the polls because the average guy doesn't know. He knows he's not making it.
Mhm.
At least not if he's getting an adjusted inflation based on the government's consumer price index, which many people are. If you're on Social Security, that's what's happening to you. And I'm one of those people on Social Security, so
Mhm.
I can tell you if someone came along and said, "Yeah, we're going to work and we're going to adjust the Social Security so it gets back up to what's needed to cover normal living expenses," I would be very inclined to say, "Hey, that's a guy I'd like to have in office."
Mhm.
That's just me.
Well, I can understand that, John. And, I don't know that the political will exists to be able to do that because it seems like a really a double-edged sword because it either means, a lot of pain to be able to get back to a place where that ends up being feasible, and or all we do is print even more debt, even more, bring the system even closer to using up all of the tax base for social security and these entitlement programs. Like, how do you think that would actually be feasible at this point?
It may not be. I mean,
Mhm.
you're raising the key points. It's well off of base. It might be something that have to be done gradually. Saying we're going to, because we've been understating it, we'll have to add. We're going to add an extra 0.5% per year into the CPI going forward here till we catch up. Something like that might be manageable. They get their actuaries and such working on it. But it's not. It's killing the average guy now,
Mhm.
and that's does not have a happy ending.
Yeah.
We're seeing it in the again, we're seeing it in the consumer sentiment, and that could be a shock to the political system, because the traditional things that they would look at are how's the economy doing, how's unemployment doing. These are all factors. If they're happy and things are going well, people will tend to vote the incumbents back into office, or keep them in office. Mm. But as the average guy senses that maybe he's not getting what as it would the same. It's not that he's not living the way he was 10 years ago, or 20 years ago, or God forbid 30 years ago. There's a major sensitivity there, and someone hits it in the political spectrum, saying, "Look, we've got to get this back into balance." It might be something that could be played out. I'm not a politician, mm-hmm. But I'm sure there are people in the system who could probably find a way around it. It means that they're going to have to cut some of their spending, mm-hmm. down the road, and a lot of the pork and such. It's a matter of rebalancing the system. But if they don't rebalance the system, where we're heading, even as it is now, I mean, they have to play games with gasoline prices to keep the headline inflation down coming into an election. It's out of control, and that's and it's going to get worse. There's nothing that they have in place to contain it. They can move the numbers around a little bit in a given year, in a 6-month period, and they can make promises here and promises there. But unless they do something to bring the deficit under control, that's the primary problem. And along with the related extreme money expansion by the Fed, we're heading into a hyperinflation. And I think we can see it beginning to break in the next year or two. That's how close it is. And as it begins to break, there'd be a lot of political turmoil. In fact, there could be a lot of turmoil against the dollar. I think I'm looking from here to 2 years out. I think 2 years out, you're going to see a much higher inflation rate, a real problem inflation rate. And I think we're going to be in a very deep economic downturn, an inflationary recession, depression. Not a good environment for incumbent politicians, but it's something that it's very difficult for the government to address. And the worse the inflation gets, the more something like holding physical gold is a hedge. It's something that maintains the purchasing power for individuals. If an individual put his money into gold back at the time that the government did what they did, they'd now be seeing increases in the price of gold that are the same as what you're seeing in what have been implied by my alternate inflation number over time. Mm-hmm. The underlying gold price here is caught up with my inflation number. And it's not that I think it's nothing more than just its traditional hedge against inflation. Over time, you can have all sorts of games that are played, but the physical gold can be intervened with. You can have wars. You can shut down private ownership of gold. But over time, it does catch up, and the gold holds its real value. Its purchasing power over time. That's its beauty, mm-hmm. and that's confirming where we would have been had the government not played governments here, played its games here and understating the headline and inflation for purposes of keeping Social Security payments down and allowing the Congress to spend more money in other areas.
Right, John. Looking at this at this gold chart that catches back up to your inflation metric, let's say.
Mm-hmm. Right.
Does it end up overshooting that at times as well?
It hasn't. It hasn't yet. It's catching up. There may have been a little bit of bumping around at the beginning, but there's been a lot aimed at suppressing gold prices as well as inflating.
But through history, have there been instances where it ends up overshooting the inflation rate as per the chart? For example, like in 2010.
Well, there's some variability here, but it's since if you go back to the 80s and before, we didn't have the big dichotomy. The big dichotomy has come about when they started under reporting the CPI, and so what's catching up now, and believe me, gold prices are manipulated regularly, but you do have an underlying fundamental market, and this is global, which makes it a little more difficult to manipulate. If you look at that plot, you'll see that over time it's tended to undershoot the inflation since the well, at least since the 1980s, when the government was playing games with it. But now it's catching up, and it's just about caught up right now. So it's you haven't had quite as much volatility as this in recent history. So what you're seeing now is more volatile, but the general direction is to the upside, and it's catching up again where the inflation was. The standard, if you use the price of gold as a standard for inflation over time, and certainly the price of gold again gets manipulated and knocked about by central governments and such. But over time, on average, it is it's your basic hedge against inflation, and that's what we're seeing now. So you're looking at it and say, well, look at the money I would have made if I'd bought gold last year. Guess what? If you'd held it, you'd be there now, and you would have stayed much closer to inflation, keeping even with underlying inflation, than you have relying on the government's headline inflation numbers.
John, when we look at GDP, how far off is that number there as well? It seems these numbers are misleading or can be misleading as well. So how far off are those from real GDP as well?
Well, the real GDP is really a political construct. The way it used to be done, it had a good meaning and a closer relationship to underlying economic reality. It is very heavily gimmicked right now, and the very strange thing that we're seeing is that the implicit price deflator, the inflation rate in the GDP, is running up around 3% year over year. Yet the underlying consumer price index, and not just the consumer price index, but the inflation in the underlying economic series that, when they're put together, become the GDP, is flat to negative. The inflation numbers, the deflator, there have been a lot of gimmicks done to the GDP. It has very little relationship to underlying economic reality, and I'll contend that its annualized growth rate runs about 3 percentage points above the actual, And if you look at, well, if we look at the year-to-year change right now, the GDP is up 3%. It has been for a couple of quarters. But if you look at real retail sales, that's it. Retail sales reported by the Census Bureau, deflated by the Consumer Price Index. Industrial production, published by the Federal Reserve. Cash Freight Index, published by the private entity Cash Freight, but it reflects national freight volumes. You look at housing starts. That's out of the Census Bureau, and they play a lot of games with their some of their housing numbers. But all those series, which when combined give you the GDP, they're flat to negative year over year. Now, how can that be? Where the GDP is up 3% year over year? It's nonsense. The GDP it's become so heavily politicized it has no real touch with the real world now. Now, there is a difference. The GDP has two components: the gross domestic product, which gets the headline reporting, and gross domestic income. It's the income measures the aggregate income, and the product measures the aggregate product. And in theory, the two series are equal the way they do it. Although that often is not the case. What we're seeing right now is a dichotomy where the gross domestic income is basically where the product is just surging ahead. The last time that happened was at the onset of the Great Recession. And last time you saw anything like the economy, again, that we're seeing now between the GDP and the monthly numbers, again, back to the Great Recession. And that's we're seeing a number of signals here that are, that's interesting. Last time we saw that was a Great Recession. I think instead of our being in a booming economy right now, which the Fed is talking about, again, which is nonsense, with the economy's not booming. And it's in a booming economy that's driving inflation, which is what the Fed is contending. What's driving the inflation is the amount of money that the Fed pumped into the system. And again, when the pandemic hit, and it was a difficult circumstance, and I'm not criticizing anyone or any entity as to what they did in that point of time to save the system. They saved the system. Thank goodness. But again, what the Fed did was they pumped in 30 years worth of stimulus, and it's still there. It saved the system, but it's also driving inflation. And it's difficult for them to remove it from the system. So it's the inflation is being pushed from the monetary standpoint. It's being pushed from and again, related unfettered debt growth, unfettered government spending, just out of control. And there are no limits now on the debt expansion. It's basic supply and demand. You supply too much money into the system, its price goes down. That means you're seeing higher inflation. So the funny thing is, we're seeing with the gross domestic income, which doesn't get as much press as the gross domestic product. That's showing a lower growth rate than the gross domestic product. They do tend to vary over time, but it's a lot closer to what you're seeing with the monthly economic statistics, which are showing a flat to negative economy. That's not a booming economy. That's a recession. And I think that's what we're really in. And I think you're going to see an adjustment to the numbers over the not too distant time, when you're going to find us in a high inflation with a deepening recession, an inflationary recession, depression. And I think there's a risk of hyperinflation here, again, because of all the factors that still keep going. The Fed's still got that money supply there. They haven't pulled
with that
that back.
massive deficit.
And the deficit's out of control. No containment on it. No containment on the debt or the deficit. And they're just happily rolling out of this next election and hoping they're going to get reelected, and we'll see what happens here. But what's being done there is setting the stage for a tremendous inflation, and also for a tremendous crash in the headline GDP. If the underlying economy is not there, there will be a day of reckoning with that headline GDP. And in the financial markets, I'm not looking at something here which may sound contradictory, but it's an inflationary recession that can be very severe in both areas, severe inflation and severe economic downturn. And we're already seeing the economic downturn, and we're at least if you look at the money supply, we already have the inflation in place, and then the deficit spending. It just has to play out. It's a dangerous environment. What does the average guy do to protect himself? Hold some physical gold, solid assets like real estate. I mean, you end up with real estate has got that real term. It means that's actual. That's inflation adjusted uses the term real. Says the real growth is adjusted for inflation. It's called real estate because the real estate does tend to act as a hedge against inflation. It has varying liquidity when you have bad economies and such, but it's a hard asset like gold and silver. It's just not portable and not necessarily quite as liquid.
Mm-hmm. Well, John, it's interesting to look at, GDP and see the real number be confirmed by things like housing starts or industrial production, as you mentioned. And that kind of brings me back to that point that you were mentioning about the consumer sentiment index. You're going to be writing a series here this week. We're speaking on August 20th. You're going to be kind of updating this series of really looking at 2019 to 2024. And it's crazy to think that it's been 5 years since basically, going into the start of the pandemic. But has the consumer sentiment index ever recovered to these pre-pandemic levels?
No. In fact, it's the consumer index, which I've always, if you read anything I've written back over time, I say this is your best indicator of what's happening to the GDP. That's consumer sentiment. It's published by the National Bureau of Economic Research, which, although it's a private entity, is very much public because it's the entity that defines U.S. recessions. Mm-hmm. You ever hear someone say, we're officially in a recession? It's the National Bureau of Economic Research that publishes that. They were puzzled because why hasn't consumer sentiment boomed along with the headline GDP, the headline economy? And but their sentiment number has never recovered. It's still something like 30% shy of where it was pre-pandemic. Mm-hmm. That's unheard of in something of an environment where you're just booming along. So they wrote a paper on it, and what they concluded was that there was a problem with inflation reporting. That back in 1982, and this is when I started with my numbers, that the government redefined inflation. And so the headline inflation got reduced over time, but the way the inflation used to be reported it still continues. And again, I'm estimating there's an 8% percentage point differential there now. What they concluded was that some of the things that they eliminated from the CPI were areas that would be showing much higher. People buying a house, for example, would be much higher, and as a result, the sentiment is lower. People are experiencing the cost, but it's not in the CPI. So that they're talking about the change in the CPI back in 1982 had the effect of eliminating certain things from the CPI that probably still be there, because the average guy's still paying for that stuff, and he knows he's paying for it, and that's why he's not so happy, and that's why the sentiment hasn't boomed above the where it was before the pandemic. In contrast, you have the consumer confidence measure, which it's basically a number that's hyped along with the government statistics.
Mhm.
But that sentiment and the National Bureau of Economic Research, those are good areas to look at. If they give you a straight story, and so that I'm writing about that the next couple of commentaries detailing detailing the issues there. The average guy you can't fool. He knows whether or not he's doing better than he was before, and the way the questions are asked by the National Bureau of Economic Research are, how are you doing? The consumer confidence survey, when it's done, it asks people, how do you think the economy's doing? And I've known Hal Sindlinger was a guy who was an early consumer pollster. He's been dead for a number of years now, but he was a he created a lot of the work there that was used later by others. And the question he always had with the consumer confidence was asking them, people, what's the GDP doing? People tend to parrot what they hear.
Mhm.
If you ask a guy how he's doing individually, you'll get a straight answer. And that's the difference between the consumer confidence. That's what's put out. That's people are reflecting the popular press, what they read in the press. If you look at the sentiment, that's how are you doing. That has not recovered. And again, the National Bureau of Economic Research looked as to why that had not recovered, and then they decided that it was the effect of the inflation numbers that were changed back in the early 80s that have thrown that out of whack.
Mhm.
So again, it tends to confirm the underlying reality. How can retail sales be flat? Industrial production unchanged or negative, and that includes mining. All the oil production. Then you take the oil production out, it's negative. The headline happy news is headline happy news. It's not too meaningful. What can I tell you?
Well, John, in that, do you think that some of the adjustments over time in the way that CPI was measured, do you think that some of those are appropriate, or should we never have adjusted it at all?
I would have left it in place. At least then you have a consistent series over time. Now you don't have a consistent series from before 1982 to date, and it changes every year as they keep changing things. Its relationship to, well, at least as I've calculated it, is about 8 percentage points.
Right.
Aggregate right now, difference year to year change, which is significant, and that's why and again that's why what the National Bureau of Economic Research is finding is why sentiment has not moved positive. It's still down 20% from its pre-pandemic, or down 30% from its pre-pandemic high. The pre-pandemic high, and it was an all-time high, or at least a 40-year high for consumer sentiment, was in January of 2020, month before the pandemic started to hit. That's what was that. So at that point in time, consumer sentiment was as high as it's ever been. People were doing well. And then the pandemic hit, and boom, it just took it down.
One of the points that we touched on earlier, John, was this idea of emptying the strategic petroleum reserve and
Yes.
really needing that stockpile of oil in a time of war or conflict. But considering how things have changed and the amount of domestic production we have now, do you think that need is still there for that capacity of oil still to be had domestically like that?
If we had another Arab oil embargo, which is what it was set up to, which is what triggered its setup, and that's always a possibility. Anything, you get a major war in the Mideast, and that's an area that still is not happily settled politically. You had a major war there, destruction of petroleum production. You still have that potential.
Mm-hmm.
We're still dependent on foreign oil. We're not oil independent.
Mm-hmm.
And
is that because we need other grades of oil to be able to blend to properly make a product that is usable?
That's a separate issue.
Okay.
I'm looking at the overall supply circumstance.
Mm-hmm.
And from the overall supply circumstance, it would be anything like a major cutoff of volume. Well, that will have a ripple effect throughout the system.
Mm-hmm.
Yeah, the psychology will be there to spike it. You saw what happened when we had the oil crisis. That's why it was set up. If you have that flexibility there, it gives you a way of at least having some alternatives to containing the crisis. If you're shy, I mean, what's there is still a significant supply, so it's not as though it was all drained, but it was drained significantly. Again, it's down. I think it's 42-33%. And right now, they're draining gasoline reserves, not the petroleum reserves, but gasoline reserves, mm-hmm. to keep gasoline prices low. So that's presumably got to be replaced, got to be produced. And if you had a major disruption, that affects everything. So you could see a big spike in prices. Anytime you have a shortage there, it'll give you a spike in prices, and the idea here is politically is to keep those prices low coming into an election, so the inflation numbers come down. And the reason the CPI was down recently is because of that drop in the gasoline prices.
Right.
It's not. It's artificially structured there. It's not due to fundamentally good supply and demand issues. It's due to very controlled and orchestrated supply and demand issues that are borrowing from the future. And when you borrow from the future, when you have the reserves and such, that's what it's for. You borrow from the future, and you can get through a rough thing. But the rough thing here is it's political. It's not survival. And you go back to another Arab oil embargo or such, then you're getting back towards the survival end, and that's the time you don't want to be shy on the reserves. And I wouldn't want to make any bets on the political stability of the Middle East in the next 4 or 5 years, let alone the next year.
So, John, based on your data, when do you think that we had a recession start?
I think it started as the pandemic hit. We haven't had a normal circumstance since. Mm-hmm. Look at the price of gold. That's give you an indication of what inflation is likely to do. What people are reading in the whole system saying, "Gee, we've got something happening here. We're looking at higher inflation again." Mm-hmm. Again, that chart that you mentioned where it shows shows the price of gold over time and the headline inflation rate, which stays low, and my number, which rises, and which where the gold prices are eventually catching up now. That's the that's where you're headed. That's your basic balance point in the system, and the fact that people are looking at a system that is not stable. If the system were stable, and they had adequate supply of what was needed, you wouldn't be seeing those prices rise. It's very heavily gimmicked, and particularly coming into an election.
Mm-hmm.
After the election, you're good for at least 2 years till the next midterm.
So you think that reality is going to hit us before then, before the midterm?
Well, it's I think it's hitting. I mean, that's what we're seeing in the underlying numbers. What they report with the inflation remains to be seen. I'll be talking about it, but the underlying reality, underlying inflation reality, and gold prices get manipulated as well over time by central banks, particularly when they're not doing a good job in controlling the respective value of their currency against the rest of the world. But what we're seeing now is, I think, fundamentally tied to the shifting inflation environment, and one that is clearly getting worse. We've had all these gimmicks holding it in place, keeping it down before elections. It's keeping it down before the election. Now, after the election passes, they're going to have to restock the stuff that they're depleting. That's going to spike the prices again. The low gasoline prices that you've seen, or the relatively lower gasoline prices that you've seen, coming into the 22 election and coming into what is now the current election, where prices are starting to drop. That's all been designed to do that before the election by borrowing from the future.
Right.
So there'll come a payback, and the payback will be higher gasoline prices, higher inflation.
So, John, when we think of the interest on the federal debt, do you think that this is a situation that only compounds from here, or if rates, come back down a little bit and the tax base grows and or stays steady, is this a manageable situation?
Doesn't seem to be. There's no real effort in Congress to bring things in balance. People are looking at a difficult election ahead, and they're looking to spend as much money as they can to get people to vote for them, and in the process, they're surging the deficit. There's no debt ceiling anymore. It's been waived. It's out of control. How are they going to bring it under control after the election? I don't know. We'll see how the election goes. See if anybody talks about it. But it's already, what has been done there already is in the system. It's already working into the inflation. And I'm talking the hard inflation that people will be experiencing, not the happy numbers that come out of the Bureau of Labor Statistics that say everything's still just fine and dandy.
Mm-hmm.
The average guy finds that his paycheck, say his paycheck was meeting his needs 5 years ago, but it's not meeting it now. It means his income's not rising with inflation. And if he's got some kind of a cost of living adjustment in there, it means the cost of living adjustment's understated. And that's a very common problem,
mm-hmm.
including people on Social Security specifically, designed by the U.S. Congress specifically, so they could have more leeway in their budget deficit spending starting back in 1982. And that's, we're looking at 40 plus years here. That's That's how long it's been out of whack, and it's gotten worse each year, a little bit worse.
Mhm.
So, and now it's going to be very difficult to contain the genie that they've been letting out of the bottle very slowly, but he's getting there. I think he's effectively out.
Excellent, John. Well, that's about all the questions I have for you today. Is there anything that you'd like to leave our listeners to think about or to consider before we wrap up?
Use your common sense. If you're seeing things out of the government that don't sound right, it's not true to your experience. I'd go with my own experience and at least consider that in terms of making my decisions. The best bet I can give you in terms of a long-term hedge against the where the system is heading, and I think it'll be the effect of the ultimate, at some point, bankruptcy of the U.S. dollar. Would be the holding of the gold and silver, particularly physical gold. Don't need a high numismatic value, something that's got the closest, whatever you can get that's closest to the physical price of the metal. Because the numismatics will be there for the rare coins, but it's the fundamental price of the metal that reflects the inflation. Mm-hmm. And that's what you're beginning to see now in the recent rally in gold prices. It's getting up to very close of where it should be, according to my alternate inflation number. And it's been doing that in the last year or so, but the process of catching up is accelerating right now, which to me means that a lot of people are getting very nervous about inflation, and they're seeing inflation in their own lives that they're not comfortable with.
All right, John, thank you for going over all of these topics with us today and sharing your information with us. I understand you have a couple issues with your website, so where can people reach you right now to get more of your your stuff?
I have a website that collapsed back in August at www.shadowstats.com, and if you go to that, it's got 20 years of archives of my articles, and it explains some of the background. The problem is that where we'd had a good web host for 20 years, when they went out of business, I found when I moved my website to the new web host that the old programming on my site did not work well there. Mm-hmm. So I'm in the process of getting that rebuilt. But what I've done very simply is for subscribers, they're receiving emails with links to the commentaries and to the alternate data files, which give you the background of I publish alternate data estimates on the CPI, the GDP, unemployment. An annual subscription there runs $175, and right now I'm offering a complimentary second year. The order 1 year, 6-month subscription's $89, and if you want to subscribe, you have to contact me. You can't do it on the dead website, but you can get a lot of background there. Mm-hmm. Just contact me at John Williams at shadowstats.com. John Williams, all one word, shadowstats, all one word.com. And I can set you up. I can give you whatever information you need. I thank you, sir, for having me on your program.
Of course, it's a great pleasure, John. Thanks for your time.
Most welcome.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.